Hey everyone, this is Kirk here again at optionalpha.com, and in this video we're going to talk about the differences between historical and implied options volatility. So this is, for me, undoubtedly one of the most important things that you need to learn if you want to be successful trading, and it's this concept of historical versus implied volatility and how it relates to options pricing. Now, more specifically, what we're going to be talking about in this video is the fact that options pricing is overstated or rich long-term because implied volatility overstates the expected move of an underlying stock, ETF, or index. Now, just as a very quick review of volatility, if you are looking at a stock that is usually trading around $100, a stock with low implied volatility would look like this black line here, which has a lot of small movements, again, still trading around $100. It's still the same stock. It starts and ends at the same place, but the volatility or the price movement is much less versus a stock with high implied volatility. And that stock is still going to start and end at the same place, but you can see it's got a lot bigger swings in its option or its stock price. Okay. Now, in very simple terms, because it's not that complicated, historical volatility, or HV, the way that we see it here at Option Alpha, is always looking at past events. So what has happened before in the past? When you hear people talk about historical volatility for a stock, it's an actual number. It's a known number. We know exactly how volatile that stock has been before in the past. So for example, maybe Apple stock, the historical volatility might be 10%. And I'm just pulling this out. I don't know what Apple's historical volatility is, but you can get the picture here. So if we know that Apple has traded before in the past around 10% volatility, meaning that it's moving up or down, 10% each year, we know that that's the number. That's the historical volatility. But implied volatility is a number that's derived from options pricing and is a forward-looking or future projection of where the market expects the stock to move, or how much the market expects the stock to move. So for example, even though historically Apple might have only moved 10%, right now the market might expect Apple to move 15%. Okay, so the future expected move of the underlying stock. And again, that's the implied volatility. That's the assumption volatility. That's what they really should call is assumption volatility. So implied volatility is derived again from an options price and shows what the market implies about the stock's volatility in the future. It's based off of pricing from at-the-money calls and puts. And this is what's really cool about options pricing is that almost every number in options pricing is known, meaning it's a number that we can pinpoint, the days until expiration, the intrinsic value of the option, so the difference between the stock price and your strike price. We know all of those numbers. But what we don't know, what we have to imply or assume is how volatile is the stock going to be? Is the stock going to move really wildly over the next year, or is it going to be pretty calm, right? And that's just an assumption that the market has. Now remember, if the market is expected to swing wildly in the future, then the value of all options on both sides would be higher because traders expect a chance or a higher chance of the market swinging into a profit zone. Okay, so in this, most people don't understand this, but they assume that it works just on one side. So if volatility goes up, then put options go up in value. No, all options go up in value because the market is assuming more volatility across the board. It doesn't necessarily say which direction that volatility is going to go. So all options go up in value because they might be worth more money if the market's swinging really wildly. So what most people don't understand too is that this happens in a normal distribution pattern. What I mean by that is that markets move in a normal distribution move. Yes, there's some positive skew because I don't want to get a bunch of people to email me and say, well, why have the markets always been increasing? It's not that they don't increase. It's that the distribution of moves on a daily basis is a normal distribution, which means that you're never going to have consistently a 1% move up every single day. You might have a 1% move up today and a 1% move down tomorrow. And then you might have a 2% move up and then a 2% move down. Okay, so the distribution of price movements is normally distributed. In fact, we can prove this because we went back all the way to 1990 with the Dow Jones. We tracked every single daily percentage move in the Dow Jones since 1990, and this is the distribution. So you can see here that basically most of the movement in the Dow Jones during that time period was between negative 0.4 and positive 0.4. This is a normal distribution curve. It looks just like all the other curves that we have out there, okay? And again, probabilities are factored assuming that markets move in a normal distribution, which means that you can't gain any edge trying to pick a market directionally, okay? Are there going to be times where the market makes a huge move lower, negative 5% move? Yes. Are there going to be times when the market makes a huge move higher, plus 6% move? Yes, but those are outliers. That's not what normally happens, okay? And so what this means is that when you look at implied volatility, you have to think about the normal distribution graph as being either relatively high or relatively low. And so what I mean by that is that if we are looking at low volatility, okay, you're going to have a distribution graph that's very tall and skinny. And we'll look at it here in a second on a chart here of Apple. But again, very tall, very skinny, because the stock, if the stock is at, say, $50, might not move all too much around $50. It might move up to, 55, and then it might move down to maybe at the very bottom end, $45. So a very tight, very small range. And again, that's a tall distribution graph or low implied volatility. If implied volatility is really high, then what you have is you have a much flatter, much wider distribution graph. And that means that now the stock has a good chance of moving, say all the way up to, $65 up here or down to, say, $35 down here, okay? So now the distribution is much wider. Volatility, the stock is going to move much more wildly, and therefore there's a good chance that it could hit these further extremes, okay? So that's what the really key point here is to remember. Now again, one of the ways that we gain our edge in the market selling options is because implied volatility overstates the expected or actual move of the stock in nearly all cases long term. And let's actually back up here for a second because I did want to go over this and kind of show you guys what one of these distribution graphs looks like on a chart. And you can actually pull this up on Thinkorswim. It's a study called the probability of expiring cone. There's a million ways that you can calculate basically the probability of a stock reaching any particular point. But this is a good visual that I like to use with a lot of coaching students. But this is Apple stock right now as of the time that we're doing this video. And I basically pulled up two different probability cones. One probability cone here in purple is the 70% expected range of Apple stock over the foreseeable future. So as the stock goes out into the future, this purple cone is the 70% expected range that Apple should trade in based on its history of making moves. So all the moves that it's ever made, the magnitude, however long it took to get from, a 1% move to a 5, like did that happen in a day or did it take 2 days? All of that stuff is factored in, plus implied volatility, and this gives us our expected range. So this assumption that 70% of the time in the future, as we go out towards these certain dates in the future, Apple should move somewhere in this range. So now you can see that there's probably a very low likelihood that at least in the next 6 months, Apple gets to around 135, right? Because the 70% highest likelihood range is about 121 that Apple gets to that price point by August, okay? So 135 seems like a real big stretch, meaning it's really never made a move that higher. Does that mean that it can't? No, but has it historically ever made a move that higher that would lead us to, or consistently made a move that higher over that given time period? Probably not, okay? So the likelihood of making that move is not that high. The other cone that we have here is a 90% confidence cone, meaning this is the 90% probability range that Apple will move in. And naturally, this cone or this distribution graph is much wider because now the calculation has to assume that, okay, we want to be right about 90% of the time. So 90% of the time, Apple should move within this wider range, okay? And this gives you a really good idea of where Apple is going to go or could go and where it could not go, again, based on different dates. Now, what's really important about this is that if you think about this cone as just expected implied volatility, meaning this is our taller, okay, or semi-taller distribution graph, okay, we could assume that this purple line, just for the sake of argument, is a 10% volatility assumption, okay? So we assume that Apple moves at about a 10% volatility heading off into the future. And it should reach these ranges based on that 10% calculation. But if implied volatility goes up and now the market is assuming that Apple moves at a, let's say, 20% implied volatility number, then we could assume that that range gets expanded out vertically up and down. So the magnitude that Apple could move up and down gets expanded. And now it's this kind of orange or yellow line here on the chart. Okay, so there's a couple different ways that you can look at it. These are actually probability ranges, so I don't want to confuse you. They're not assuming that volatility goes higher, but I'm proving the concept here that as the markets assume that Apple gets more volatile and goes from less volatility, maybe moving like this, to more volatility moving like this, that expected range gets higher and higher and higher. Okay, now as we look at options pricing, again, this means that implied volatility tends to overstate what actually happens. Okay, so going back to our charts here, if we think that Apple should move in this purple range here about 70% of the time, when the actual movement happens, meaning when Apple actually plays out this timeline and actually trades, if we retroactively go back and look at the volatility of Apple, we may find that it only moved, say, this much in that time period. Okay, so it only had a range that was much smaller than the market expected. So meaning if the market expects Apple to move, let's say 10% higher or 10% lower, it may only move 8% higher or 8% lower when that timeline actually plays out, when the prices actually start to, develop inside of this expiration cone or this probability cone. Okay, so really important concept. Now, we are believers that markets are efficient, and in the same sense, there's no price edge you can gain directionally picking stocks. But when it comes to options pricing, we can prove the concept that we were just talking about, which is that selling rich implied volatility has been one of the rare historical and profitable edges for a trader. So on the next page, first, we're going to track DIA, which is the Dow Jones ETF. We're going to track its monthly implied volatility against a chart of the actual realized volatility or historical volatility 30 days from the time of measurement for each period. So for example, if we are going out and we are taking today's date, whatever it is, and the market at today's date assumed a 10% move in DIA, when we fast forward and look at the end of the next 30-day period, right? And we look back and we say, look, did the market actually move 10% or did it move something else? Did it move more than 10%? Did it move less than 10%? What did the market actually do? If we assumed it was going to move 10%, did it? And that's the question that we're trying to answer here, and we can actually prove. So here is DIA versus its actual, DIA implied volatility versus its actual volatility. Now, the blue or teal right here is the implied volatility. Okay, this is what the market was expecting, or the market volatility that was priced in. The more green line here, or I don't know what kind of color you call it, really green or yellow-ish, is historical or actual volatility. Okay, this is the move that actually happened. And you can see that for the most part, the vast most part, that implied volatility was always more than historical. Were there times where the market was more volatile than expected? Yes, namely 2009 at the end of the market crash there. A couple times here in 2011, the market was a little bit more volatile than expected, but the vast majority of the time, the market assumed that DIA would move much more than it did. So for example, if we just take like one data point, let's just take maybe the data point right about here. Okay, so this is back in mid to end of 2007. The implied volatility at the time right there was about 20%. So at the time, the market was assuming that DIA would make a move over the next 30 days, maybe of around a 20% annualized volatility. Okay, not 20% over 30 days, but 20% annualized. But what actually ended up happening over that 30-day period was that DIA only moved, let's say, 12%. Okay, I don't know what that exact number is, but you can see it's definitely less than 20, higher than 10. So let's assume that it moved 12%. That means that option pricing was assuming or pricing in a 20% move in the underlying stock, when the reality is that it only actually moved 12%. So if we know that option pricing is always high, meaning that it always is high assuming high implied volatility, and that the reality is that markets are never as volatile as we expect, that means that option pricing is always overstated and therefore profitable for option sellers to be selling that rich or high implied volatility. okay? In the case of DIA here, on average, the market expected DIA to obviously have a slightly more volatile environment than had been realized over the last 13 years. Now, the average difference between the DIA implied and actual volatility during this period was 6.25%. As I've said many, many times, this is a number which represents our edge as an options seller. This idea that if the market is assuming things to be really volatile and they end up not being volatile, then we have the edge trying to sell options because those options are always going to be slightly overpriced. Okay, 2 more quick examples of this just to kind of prove the point, but it works in every single market. Here's a look at gold, which is GLD, a big ETF. Again, you can see the blue or teal line here. That's implied volatility. And actual volatility is this green or yellow line here. That's historical volatility or actual volatility. And you can see here, same thing happened with GLD. Yes, there are times where actual volatility is more than implied, and that'll happen. But the vast majority of the time, the historical volatility, or what actually happened with GLD, was much less than what the market implied. Same thing with bonds. Bonds only had one chance, or basically one time period back in the last 13 years or so where the market was actually more volatile than options pricing had assumed. In fact, in some cases, there was such an overassumption of volatility back in late 2008. You can see the market was assuming that bonds would move about 40% over the course of that year, when the reality is that they only moved 20% over the course of that year. I mean, so there's a huge disparity. The market was half as volatile as traders had priced in. And so what that means is that option pricing was probably 2 times more expensive than what it actually should have been. And so that gives us, again, an opportunity to be option sellers and take advantage of that. So remember, this difference between historical and implied volatility is so key, because if an options price is mainly determined by implied volatility or future expected move, then that future move turns out to be less volatile than expected, then the option is theoretically overpriced. And this is what happens all the time. This is why option buyers lose money even though they get the direction right, because they don't factor in implied volatility. So we know and have proved that IV is always higher than historical volatility on average. That's what we just went over with DIA and GLD and TLT. And this means, again, long-term, all options are theoretically overpriced by some margin. Now, some stocks may have a smaller margin. TLT ended up having a bigger margin of overpricing, like 40% volatility versus 20% actual, right? Versus DIA, which was assuming 20%, and actual volatility was 12%. Okay, so it's going to be some margin, and that's going to be different based on different stocks and ETFs. But the reality is that the traders who are net option sellers more often than net option buyers have a huge advantage or edge just based on the math. And again, one last time before we go through an example here using real options pricing, again, this means that if the market is expecting a stock to move 20% over the year, it may actually only move if the market is expecting a stock to move 25% over the year, it may actually only move 20%. So if your options are priced assuming a 25% move in the stock and it only moved 20%, you paid too much money for that contract because the stock wasn't as volatile as you expected. Okay. Now, one of the ways that we can actually show this, and this is really cool, is actually looking at options pricing and basically doing some calculations with implied volatility here, or making some volatility adjustments and assumptions. So what I did here with Apple is, if we look at this, again, probability of expiring cone, I took this price level of 115. Okay, and why did I take this? Just because it kind of helps prove the point here. But let's assume that you believe Apple will go up to 115, okay? Or if that's the assumption that you think that Apple will head up to that price point. If you end up being an option buyer in this case, because we'll just take the case of somebody who's an option buyer, though we are always option sellers, option buying proves a point, it's very easy to understand. You'd buy a call option assuming that the stock got to that level. Now, you obviously have different dates that you can buy that option for. So you can buy that option for April or May or June or July, etc., etc., etc. Okay? In this example, what we're going to do is we're going to assume that you look at 2 different contracts. So we have the April 115 calls, which are here, and we have the May 115 calls, which are here. Now, the reality is that the April 115 calls are not worth a lot of money. And you might assume, or rightfully assume, why that is the case. And that's the case because there's not a good chance that the stock gets from where it is, 105.67 at the time that we're doing this video, up to and above the 115 strike by April expiration. There's a very low likelihood of that happening, and hence the low likelihood of that happening means that the price of that option is very, very small. It's only $8, okay? So yes, it's a cheap bet, but you've got a very low likelihood of it happening. In fact, at April expiration, which is these numbers right here, inside of this purple line, there's only a 70% chance that the stock ends between 112 and 99. So your strike price at 115 is much, much higher than where the actual expected range of the stock is. So you're basically assuming that you're taking on a very small bet with a low probability of winning. It's like buying a lottery ticket. The lottery ticket's very cheap. It's $1 or $2, but you have a low probability of winning. Same thing with this option in April. It's only $8, but you have a low likelihood of winning. If we extend our trading timeline out to the May contracts now, and we still buy the same 115 strike, you can see that those options are now worth $95 a piece. Because one, they have a little bit more time, so a little bit more room for the market to run, and because volatility is going to impact the value of those options a little bit more as you go out in time. Remember, Vega has a greater impact on options as we go out in time, okay? So now you can see, if I go back to the charts here, that if we go out to the May expiration, there's a pretty good chance that the stock actually ends in the money 70% of the time. So now our 70% probability range out in the May expiration is between $95 on the bottom side and $15.88. Remember, your strike price for the May expiration is at 115. So because there's a pretty good chance that the market could move into a range that would give you a profit, you have to pay a little bit more money to get into that option contract, right? So if you have a better opportunity or probability of making money, then the value of that option contract is going to go up. Now, here's what we're going to do. We're going to look at a volatility adjustment to both of these contracts. I just want to move this up so you can clearly see it here. So inside of Thinkorswim, and most broker platforms have this, you can actually adjust and simulate what would happen to the value of these options should volatility go up or down. Now, in this case, what we're going to do is we're going to lock the price in at 105.67, meaning no change in the underlying price. We're just going to tweak and move around volatility here so you can visually see how volatility alone, without any other assumptions, meaning no assumptions of the stock moving against or for us, basically changes the price of these two option contracts, okay? So the first thing that we're going to do is we're actually going to increase the price of this option contract by 10%. All right, so again, you can see now when we increased it to 10%, look at the value of these options and how they changed. This contract went from $8 up to $26 in value, and this May contract, which is a little bit further out, had an even bigger jump. It went from $95 up to $142. So very, very big jumps in the value of these options. Again, the stock price never changed. Rewind this video. There's no change in the stock price. We only changed the value of implied volatility, or the fact that implied volatility went higher. And again, as an options seller or as an options buyer, what we need to be aware of is the impact that just implied volatility has on the value of our options, because it is a greater impact than the stock's directional move. So if you don't get this directional piece right with implied volatility, meaning understanding if volatility is relatively high or relatively low, then you really have no real edge trading options. You're just whimsically trading directional moves in the stock, which is very, very hard to predict. Now, one of the ways that we help out here at Option Alpha is we've developed an in-house watch list that brings in all of these implied volatility figures and basically gives you a ranking system between 0 and 100 to show you which stocks have high implied volatility and which stocks don't. Now, if you think about it, you only want to be an option seller when a stock has high implied volatility. And if you are going to be an option buyer, you'd ideally want to do it when there's low implied volatility, although you do want to keep option buying strategies to a minimal in your account. Now, inside of Option Alpha, you can just go simply into our watch list. You can rank by high implied volatility only, meaning it's now going to filter out and scan for just the stocks that are in our watch list that are insanely liquid, with great volatility and volume, and only show you those ones with an IV rank over 50, because we consider an IV rank over 50 to be a good place to start selling options. Another thing that you can do is you can take this watch list and you can sort it by highest implied volatility first. So you can see all we can do is just toggle on and off and see which stocks have actually the highest implied volatility over 50%. And right now you can see one of those stocks that we have on our list is Nike. Then there's EWZ, which is a Brazilian ETF. We've got PBR, which is another Brazilian linked stock. So it's very, very easy for you to see what has high implied volatility, what you should be selling options on or not. Another really cool thing that we've built into this platform is the ability to show you exactly what strategies you should be using based on different implied volatility ranks, or based on how high implied volatility really is. So you can see here when I toggle this open for eBay and MON, that different option strategies show up based on where implied volatility is right now. So for example, eBay has implied volatility of 60 in the 63rd rank, and that means that you should be trading credit spreads, butterflies, and iron condors, versus MON, which has implied volatility in the 71st rank, and you should be trading straddles and strangles and iron butterflies. Now, remember how we talked about the expected move or expected range of a stock? Well, we've also built that into our watch list software here at Option Alpha. And now you can see what the 1 day, 1 week, and 1 month expected range is for any security that you're looking at inside of our watch list. So you don't have to calculate it yourself. You don't have to add it to your charts if you don't have Thinkorswim and don't have the ability to do that probability of expiring cone. Now you can see in here that the 1 month expected range for eBay, or the probability that eBay trades between 17.72 and 30.94 is about 70% over the next month. Okay, so the 1 month expected range encompasses a 70% probability range for that particular stock. And now you can see for MON that range is going to be a little bit different based on its implied volatility and where its current stock price is. So this gives you a really good idea of where the stock is going to trade into the future if this setup were to happen again and again and again, if these probabilities played out. So really, really helpful stuff. Again, the key here is that you really want to be focusing on selling options that have high implied volatility, understanding the difference between historical and implied volatility, because that is our edge as an options trader. So again, thank you so much for checking out this video. If you have any comments, questions, or feedback, please let me know. Add them in the comment box right below. If you love this video, if you thought it was helpful, please share it online. Help spread the word about what we're trying to do here at Option Alpha.